My name is Andrew Stotz, and I want to welcome you to another interesting discussion about careers in finance and all about investing. Today, we're going to be talking with a global investment expert who's been in the world of investing for a very, very long time. So, for everybody here, I want to welcome you and welcome all my students from the Valuation Masterclass. Good to see you guys. And most importantly, feel free to ask any questions. Just put them in the chat. Part of the reason why we're doing this is to get your questions answered, So I think you're going to enjoy this one and we're going to have some fun. So let's kick it off, ladies and gentlemen. Are you ready to rock? Let's go. Sophocles, how are you? Welcome.
Hey, Andrew, it's been way too long.
Incredible. Yeah. We were just talking about how long ago that was. I mean, yeah, I had more hair back then for sure.
You you did. You
And
did.
those
In
were
a
the
suit.
days.
You were always in a suit there, I remember.
Always in a suit. And I really, it was the days when I was head of research at Citibank and then head of research at CLSA. And I just had so much fun. I enjoyed the job of an analyst very much. And yeah, just always. But I thought, why don't we kick off this discussion? Normally, we'll say, okay, tell us about your background. But I don't want to start with there. I want to start with what you have been doing with your conference and, tell us about that first.
So, thanks. Well, it was about 2014. I had gone to London for the European CFA investment conference, something like that. And I had like a free ticket. So all I had to do was get on a plane and go. And I left that. And although there were a few nice presentations, I was not happy that there was something that I could use.
Hmm.
Like, here's something that I could apply within my own work. I mean, some of the stuff was, long-term interesting, but nothing applicable. And then I wasn't really happy too much with the networking. And I complained actually to the CFA Institute about this because I said to them, I was looking to meet some other equity guys, and there was a bunch of back office guys and a bunch of middle office guys, and there was like fixed income, but I could barely run into. So I was chatting with a guy in Germany, Tim Dutot, and he's like, well, why don't we throw together an event in the format and structure that we would want to go to? And so that's how the idea was born. And this year I'm having my 10th event in September, and it's actually fully booked as of yesterday, 8 months in advance. And I've already have a waiting list for it. And what we've done is just bring together passionate guys like yourself, Andrew, who just want to talk investments, regardless of how much money they have, who they are, white, black, yellow, whatever. I don't care. All I care about is to meet up with other people who just want to talk about investments and hang out and have some fun. And so that's really it's not for everyone. You have this vision, build it, and they will come. And no, it's not like that. After all, it's like you have to find those people where it resonates with them. And so, fortunately, I've been very lucky to meet some amazing people, amazing investors who, some people don't even know about that I actually introduced to other events and to other people. And it's helped me,
Hmm.
Sophocles, just open my mind, and become a better investor. And I'm not saying everyone that's going to come is going to be brilliant. Of course, not everyone's going to, and everyone thinks differently. But all that diversity of thought is super important for any investor. I wish I have a couple of young guys coming, and I'm thinking, man, I wish I had someone to invite me to such an event when I was young, and um, and basically become a better investor because of it. And so I was talking with some guys about a month ago, and they were saying, there's
Hmm.
nothing in Asia like this. So I thought, well, why don't we see if we can clone this in Thailand? And so we came up with the idea of doing an Asia Value Investor Conference. So there's a Cyprus Value Investor Conference, and we're going to try to pull off an Asia Value Investor Conference. And we're going to try that to do end of March in Bangkok. Actually, about a little outside of Bangkok. We're not. We put down a location as the Royal Varuna Yacht Club in Pattaya. But we're going to see maybe if we could keep it there or not, because a couple of people have had some suggestions. But we're so far about 15, 20 people, and it's not about quantity; it's about quality. I'd rather you could have. When I did the first Cyprus event, I think we were about 29 people, and there was about 16 people presenting. Now, having done that, if I went back in time, I wouldn't have done that. I'd rather stick with 20 people rather than 30, because that you'll talk with the right type of people, you'll build a community, you'll build friendships.
Yep.
And that's important, because it's not just after the event. You leave the event and then you stay in touch with these people and you continue to exchange ideas. You might even work on something together. Like I've had people at my event do activist strategies. There's an activist strategy in Switzerland going on through a couple of people. There's an activist strategy in Australia going on from a couple of people. There's other people I know have worked on. Actually, I've been jealous about a couple of people who were getting together talking about an idea, and I was, hey, why don't you let me know about this idea? And so people, some people like, I don't care who's coming to Cyprus. Sign me up. I'm going to be there just because I want to hang out in a nice environment where you're not criticized. Here's the other thing that's important. A lot of people don't feel comfortable. Like I have people with, even have like what do they call it? Like little cards,
flashcards.
Have some notes, and that's fine. Flashcards, I have flashcards. So I had one person. Yeah, I have a couple people like have some flash, and that's fine. I don't care. It's not about criticizing. It's not about trying to be who's the macho man, who's the cool guy. We don't care about that. We're there about helping each other at the end of the day. And the questions are not to be like to make me look smart. It's just to help me understand the investment, and then also maybe I think of something that you haven't thought of, which helps you. So that's what I've done. Actually, if I were to rank what was the best idea I've ever had in my life, the best idea I ever had in my life was doing this. And to me, between you and me and whoever's listening now, don't tell my wife, I think this is better than my family vacation.
So let's just talk for a couple minutes. I just want to, first of all, welcome everybody who's on and listening in. And we're going to be talking about a lot of things. I just thought it would be great to talk about what you're doing with this Cyprus Value Conference and that you're bringing it to Thailand. And so for anybody listening that is in Thailand in March that's thinking about it, I think what we need to do is we need to put some links in the show notes and stuff. So we'll have that so you can people can figure that out. They can send a message to Sophocles or to myself, and these events are for people who love investing in stocks, and one of the things that as a head of research and as a financial analyst, I was a showman. I was always on show, and I was a great presenter, and I was all of that. And that's not what many great investors are all about. Many of them do not want to present like that. They don't like that. And it's just not where they come from. And so this is a comfortable place where people just get together and here's my my best idea. Here's the thing I'm invested in. And here's why I'm invested in it. And then get feedback and people getting interested in saying, I'm going to follow up on that. So that's the key of what it's about. So for the listeners and the viewers out there, that's what we're talking about. And we'll put something in the show notes to make sure they've got, and I don't know if you got any website they should go to or any other thing.
Yeah.
I should have asked you that.
Yeah. But first on what you just said, yes. And I should have said
so
something.
Just send a message. Just send a message to
really
Sophocles or myself, and then we'll reply with the information.
Yeah. So we'll put it, it's asiavalueinvestor.com, asiavalueinvestor.com. And you can also always email me. It's Sophocles, as you see in the video, Sophocles at fatalpha.com. So that's fatalpha.com, fatalpha.com. I also have a podcast on the fatalpha.com website where you can I do like interview someone every month about
Yeah.
an investment idea, because that's what I like to do. That's the other thing I started doing a year ago, because I was sick of these podcasts where people are talking for 2 hours about some random thing that I don't care about. How they met 20 years ago and they're rambling on about the story, and I'm more like, let's get to the company. So that's anyway. But one thing I want to point out is like what you said about the presentation. I remember specifically one year there was a person who came in and they did this really flashy presentation and about a well-known company, but everyone already knew everything. So there was nothing there.
Yeah.
There was nothing. Absolutely nothing. It was like it was boring, even though it was super flashy. And then this one guy comes out from New York. He had the worst presentations possible because his secretary put them together because he was busy, right? And I got these, and when I was putting them up, I'm like, oh my God, this guy's gonna be horrible. You know what? He paused. He's like, guys, sorry about this. And then he went and talked about this company in Indonesia. And his whole description just kept everyone mesmerized. We were hanging by his every word because he was really giving us some insight. And whenever you're presenting, at the end of the day, you have to remember that you're the presenter, not the presentation. So big mistake that people do, and I did a presentation skills workshop on this, is that they clutter up all their slides as if they're going to hand it out. So if you're going to send someone, slides, sure, fill it up with information. But if you're going to present it, you got to remember you're the presenter, not the slide. Don't clutter that up. So yeah, I just wanted them to get that across, because it took me 20 years, I think. And I have to thank also Guy Spear on this, because when I got invited to his event in Cloisters, he wanted to help some people become better. And so he had actually hired a TEDx coach. And yeah. It was like whoever wanted to. And I was like, here I am. I'll do that. Get me connected to the TEDx coach. And I did a session with her, and she was amazing. And I got to realize, and it was like, this is what I tell people. It's like, what is it's like real estate. What is the golden rule? Location with presentations. It's reduce.
That's great. Now I've put the link to asiavalueinvestor.com into the chat. So for anybody that's interested, that's listening or viewing, just click on that link and you can learn more about it. And it talks about what the Cyprus conference was like, and how it's mimicking that. In addition, I know I have some people from Nigeria on the line watching, and I want to welcome you from Nigeria. And in particular, I'm going to share a video, and that is a recent video that you've done on YouTube where you're interviewing a gentleman about his investment in a Nigerian company. He was born in Tanzania. And that's an interesting one. So before we go any further, let me just welcome everybody in. And I believe, hello from Cyprus. I believe that's Christiana that's saying that, I think, because later she said, I think that's her. I think it's her. I can't see it sometimes who it is, but also said, I'm looking forward to more details on the event in Cyprus. So, yeah. And welcome to Andre, says hello.
Oh, hey, Andre.
And okay,
I know Andre.
And also one of my students and an impressive man, Rainer Michael. And in fact, he goes to Pattaya a lot for a break from Singapore. And so maybe he'll be in town during that time. Zishan. Yeah, Zishan, one of our graduates from the Valuation Masterclass, who's also working with us now. So Zishan says hi. And also Amarachi is saying hi. She's a current student in the Valuation Masterclass, trying to kick butt there. Also, another Chisom says hi, and a couple of others. Let's say Akamabe says, I'm super excited to be here. Yep. So we're going to get into some interesting stuff too about how do you build a career in fund management, but we just want to get through. Carlos, good to see you. Happy Chinese New Year. Yep. DP, it's great
Happy Chinese New
initiative,
Year.
likes it. And we have a couple more. Let's see. Aliyah is saying hi, and I believe that's from Nigeria. I know we've got others from Nigeria. If you're from Nigeria, make sure you say hi because he just was doing a video. Uh, uh,
You Nigerians have to get together and
yep,
do your own little group, you know. That's just one thing. The one thing you have to take away from here is you have to find other investor friends and just do like an idea dinner, pizza dinner, right? Every Friday or something, or once a
yeah,
month. Don't do it every Friday. Do it once a month. Because if you do something too frequently, then it kind of loses
yep.
its magic,
Okay,
shall we say.
that's a great tip right there. So
So
for I know
yeah,
that we also have one of the top uh, investment clubs and finance clubs in Nigeria. I've recently been talking with them. They've had a lot of students come to the boot camp. But for you guys that are listening and involved, think about your own town, where you are. You're in whether you're in Switzerland, like we just have someone say, I'm in Switzerland. Yeah,
I'll be there
okay,
next week.
there.
I'll be in
And
Switzerland next week.
I also have a Vladimir. Vladimir is originally CFA Association of Russia. And in fact, he and I've got some event coming up, which is going to be fun. And okay, India, we got a lot of people from India, and also from Thailand. Titi Pongs from Thailand, welcome. If you're interested and you're in Thailand, then click that link that I put in here and check it out. So I want to talk about being, I'm a sell side analyst, and I always tell people when my students ask me, like, how do I know, or what should I do? What's the difference between a fund manager and an analyst? I said, look, if you are a showman or woman like me, then you're a sell side analyst, where your job is to come up with an idea. You got to be smart. You got to be able to come up with an idea, support it with good evidence and good argument, and then you got to get out there and pound the table. You have to sell your idea, and if you don't do that, then nobody's going to listen. Everybody's busy. And so I spent time as a sell side analyst, traveling around the world, writing research, going out, meeting guys like you, and pitching ideas. And I'm just curious, like, but I also say, if that's not what you're looking for, then think about another part of the world of finance, whether that's investment banking or fund management or whatever. But I would love it if you would just talk a little bit about, like, for the young people out there who are building up their beginnings of their careers, what is it like being a fund manager? What's the pros and cons? What's the strengths and weaknesses, that you need to have? Take it away.
I'd start off with something you said earlier. You said, I enjoyed working as an analyst. So I think first of all, you have to ask yourself, do you enjoy being an analyst? And that's whether you're buy side, whether you're sell side, regardless of the mandate. Like I was working for an activist hedge fund, okay, and we did grueling work of, it's been 2 months in the company. Heck, we spent 3 weeks before we even, think about putting it on our radar, right? So we're talking about a lot of work, and sometimes, the company might, you not excite you, but excites the other people. So you still have to sit down and do the work. Whereas, if you were a fund manager, you'd be like, yeah, I don't like this. I'm just going to move on. So, but within this industry, as you're developing your career, you first have to ask, do you like putting those Excel spreadsheets together? Do you like digging into it regardless of if it's your pitch or not? Because at the end of the day, it might turn around. You might change your mind while you're doing the work. So that's one thing. Do you enjoy it? The other thing I'd like to point out is, yes, there is alpha in the work. So, a lot of people, they just breeze over ideas, or, they read Andrew's sell side report from CLSA and be like, oh yeah, I'm just going to go buy this. uh, but you know, doing that work is can create an edge. And I saw that. I saw that because remember calling sell side analysts in Europe about some of the activist cases we were working on, and we knew more about the case than these guys. And that's where I also learned that, you know what, there's analysts and there's analysts. So you could get a sell side analyst who's been covering the company for 15 years or 10 years or whatever, and he knows that company inside out. You talk to him and every second is worth it. And then you talk to some guy, he just took over from the previous guy left, he's just taking the other guy's spreadsheets. He doesn't even know all the assumptions in the spreadsheets. So there's a big difference between analysts
and just maybe I'll add into that. As an analyst, one of the things that I love about being an analyst, because when I started in Thailand in 1993, from 1993 to 2003, I was a bank analyst. That's all I covered. And I knew everything about banks in Thailand. And I was really, really the expert. Now there was some other bank analysts, Scott Christensen and a couple of others that were really great at the time that I admired myself. But by the time I had a few years into it, I had a huge amount of knowledge. And so for those people that are listening and thinking, what career do I want? I want to be an analyst. I want to be a fund manager. One of the things about fund managers, you got to kind of skip around. Now, some funds you have a very concentrated portfolio, but even then, you may have 50 stocks on the watch list. But for an analyst, it was like, 5 banks, and I just went deep into that and became an expert. And as I say to my students, the job of an analyst is to be an idea originator. You've got to come up with an idea that gets people interested in what you're talking about. So that's from an analyst perspective. What about from a fund manager perspective? What's different?
So I think it's important what you said, because I guess one of the disadvantages there is, what if there's nothing in the sector that excites you?
We were going through a boom and then a crash where non-performing loans went to 55% of the total loans. So yeah, it happened to be an exciting time.
So I mean, I think Andrew really points that out, and it's good. It's, as a fund manager, unless you have a very specific mandate, you are, sorry about that, you have to be a generalist. And then as an investor, whether you're a fund manager or you are an investor, you have to sort of pick your fights and select those sectors or industries, I think, where you can best perform in a way. So I'm not saying, go down and just cover, let's say, banks or something, but maybe commodities don't resonate with you, and you don't have the stomach for the cycles. Or it could be the other way around, where that thing excites you and you're ready, to go all in when it's, everyone's running away. Now, being sell side versus buy side, I think, even though I have to be honest, I've never worked on the sell side. I have worked for brokers and stuff, but I don't think that really counts as the traditional, because Western world type or corporate, let's say, environment. I think there is an advantage, for example, that people like Andrew who start on the sell side, is that a lot of these big banks or big investment banks, they have these structures which help you develop. So you can start on the sell side, and that might jumpstart and help push you forward in your thinking and your knowledge before you switch, let's say, over to the buy side. And there is an advantage that an analyst has, which a fund manager doesn't, right? The analyst doesn't talk to clients.
And when you say
right?
clients,
the analyst is
you're saying the end investor that's investing in the fund. Yep.
Yes. Yes. So there is an advantage. When I was doing work for, the activist fund, like I was saying, I wasn't talking to any of the investors. I was just part of the team, and Heck, I love that I didn't have to talk to
Mm,
anyone. I love that I didn't have to have response. I didn't have, there was an investment committee, but so if someone messed up and they made a bad decision, uh, you know, I I was fine. But when you're a fund manager, because before that I was managing two small funds, and you have, and it's funny, one of these funds was specifically invested in euro denominated bonds. So
mm.
imagine euro denominated bonds 5 years ago. Okay, these things do not move very much. And one of my clients was calling me every week, emailing me every week what the return was, and
That's painful.
eventually, yeah. Eventually, COVID came. Before COVID was coming around and COVID started,
Mm,
I was tired of this. So I give her a call and I'm like, you know what? This is like December, I think. And I was like, you know what? This COVID thing, it's really, it's suspicious. This thing could be a
mm,
big deal. I think maybe you're sitting on some profit. I think you should get out. And that was partially too, but I was mostly trying to get rid of her. So she redeemed, and I was like, thank God. And then she went on to say how much of a genius we all were
got
because
out at the right time. Yeah,
got her out at the perfect time. But you don't have to
yeah.
deal with that. You don't have to deal with that and that's why you see a lot of fund managers turning into family
Mm,
offices. So yeah, you have a big fund manager, he's in the billions. He says, like, I'm fed up with, clients and everything. Heck, I was even talking to a guy who comes to my event who is a genius, right? One investment he told me about has gone like up 30 times in a year. Just it was something that was coming out of restructuring. It was just ridiculous, right? It's a super smart guy. I said to him, look, I have this idea for this new structure we could do, and we could do a mix of strategies. And I think that could be a
mm.
good selling point to like a little niche fund we could do. He's like, I don't want to talk to people. I just don't want to deal with it. I've done that. And like he was a partner in a fund. And he's like, I just don't want to talk to anyone. I just want to do my thing. And if you think about it, you're also foregoing
Yep, yep.
also money here in a way. Because if the guy's smart, brilliant, he's gonna do fine, he's gonna raise money. He's like, I don't want management fees. I just don't want to deal with people. I'm fine on my own.
Yeah, and it's,
So there is a big difference there. So it's something
yeah,
someone
and I
has
was
to
saying that.
consider.
Go ahead.
The other thing, oh, just quickly, another little story here is that people get too excited about the idea of becoming fund managers, right? It's not as glamorous or as, exciting, and you're not like, you know, there was a friend of mine, he's in Switzerland, another friend of mine who's in Switzerland, and he's thinking about starting this fund. And it's just too small. It doesn't make sense. And also, it's very hard nowadays. It's probably not going to
Mm.
work out economically because the thing is, it's like today, it's almost impossible to raise money. It's almost impossible to start a fund. You got to be extremely connected, extremely
It's
lucky,
hard to raise money.
right?
It's
So
just such a competitive
yeah.
space.
So I said, you know what? It's gotten so bad. I mean, back in the day,
Yeah,
Andrew, when we were starting out, you had like 10,
yeah,
15 million.
yeah, yeah.
You start a fund,
Wow.
right? Now they're like, people will, talk to you. People, everyone's
Yeah.
turning passive. It's
So,
very difficult. When you mention your across, everything that was in euros. So
mm,
it could have been emerging markets, Roman. And actually, where you could find some alpha in the euro-denominated bonds was like private companies,
right.
or emerging markets. So I mostly did, B plus, BB minuses in that portfolio as part of the mandate. And so you were able to do that. And the secret in bonds is basically, try to get a little bit extra yield, but with better quality. Because if you look at some of these ETFs and like, let's say, benchmarks, there's a lot of horrible over leveraged companies in these. So I don't know. I think it's easier to outperform in the bonds
That's
than in
interesting.
equities.
By the way, Roman is in Netherlands, and he's a graduate of Valuation Masterclass. So good to see him here. And Yeah, it's curious what you're saying about managing a bond versus a equity portfolio. I would like to ask you about that, but before I do, I just wanted to highlight that if you're the type of person who you say, Andrew, I'm not really a showman, and I like crunching numbers, I like looking for the story, then being an analyst in a fund management house is a great job, because what your job is to find ideas, however you find them, and then feed them to the fund manager and have an internal discussion about these are some of the ideas. One of my guests on my podcast, my worst investment ever, was they talked about every single investment idea that came into their view had an advocate and had a devil's advocate. And they always assign a person to take the opposite side for their discussions about that. Thought that was very interesting. But so if you love crunching numbers, love finding ideas, it's not, maybe you're starting off your career, you're not going to be a fund manager right off the bat, but you don't want to be a showman like a sell side analyst, then try to find a job working as an analyst at a fund management company.
And one other thing I'd like to point out is, like, I was managing those two funds. The two funds were doing well, actually. The one was a balanced fund, which also included some global equities, and it was in USD, and the other one was just euros. And while I was doing that, and it was doing fine, it was like I was there doing that for about 2.5 years or something. One of the guys who comes to my event offered me this job to work with the activist. So he's like, would you like to come work with us? So, and the reason I accepted and did that and went for I went from fund manager, right, calling all the shots, to go to being part of a team, not calling all the shots. And it wasn't money. The immediately I told the guys, I got this offer, they immediately price matched it, right? So I still went, though, because I wanted to be part of this team where there was other people who were going to challenge me as well and help, and for me to develop. And so I think that's important. If because a lot of the smaller funds, they're just maybe just one guy. I mean, do you want to do that? And do you have enough experience to do that? It takes years to realize how dumb we all are.
Yeah, one of the great books when I was young was Peter Lynch, and his different books that were, great, One Up on Wall Street and all that. And he's a perfect example of like a super intense fund manager who really his whole life, I think he ran the fund for 15 years, and then he left Magellan. And I believe that he left after 15 years. And but the point was that he was so intense. And so, yeah, if you want to be a fund manager, you're on the line. It's all you. And you're going to have some analysts that are feeding you stuff. You've got to be reading everything all the time. And as an analyst on the sell side, you've got to also, I think that's one of the things that gets me excited about the job of an analyst. In fact, two of my recent hires out of the Valuation Masterclass Bootcamp are both working on creating PowerPoints and research on interesting companies. And it's just been fun. I haven't been doing that as much as I used to. And so that's definitely been fun, and looking for the story. And that's just a blast. I was just looking at one of the videos we did was on Hermes. And one of the things I was just talking about is like Hermes basically is sitting on 52% of its balance sheet in cash, which just seems crazy. Like, who wants to invest in a company that just has all this cash? But you just also see that during COVID, it's just COVID is an opportunity for them. It's not a crisis. And that was one thing I found really fascinating. And then the other one, I was looking at my own coffee business, and I was asking my business partner, Dale, I was like, so we get this much, let's say, operating profit. What percent of that operating profit flows through to free cash flow of our business? And so I gave him the number, which was tiny, not a lot. We have a CapEx, we have working capital needs. And I said, you want to know what it is for Hermes? And he's like, yeah, tell me. And I said, 90%. 90% of operating profit goes through to free cash flow. And it's like, wow, okay, that that is impressive. So the story angle, finding a company. Now everybody knows that company; it's very highly rated and all that. But coming up with a story to me has always been really such a fun part. It's a hard part to teach in the valuation masterclass. I haven't really figured out how to get my students to be great at initiating these
Mhm.
stories. Yeah. Uh,
It's hard. And that's one part, Andrew. I'm like have been, I'm still working on myself. And I'm very lucky. I used to work with a guy um, um, that
mm,
was great on that, and I think that's where you see some fund managers. One thing I noticed some fund managers, they might not even have an Excel or a model or anything, but they have the whole business wired into their heads and an understanding and insight, which basically that's their edge. You cannot copy that. So, a lot of fund managers um, succeed because of that. So, they might not have their DCF and they might not have their Excels, but they get away with it because of the insight. One and two, they
yeah.
don't overpay. Now think about Buffett, right? Does Buffett have a DCF? He doesn't have a DCF, right? But he has this ability, right? And he doesn't overpay, and then he gets good businesses. And what does good business mean? It means creating value. How do you create value? When your return on invested
Mm,
capital is greater than your WACC. It's so simple, right? So you buy a company with a return on equity, I don't know, 20, 30%. You don't have to do the calculation for
yep.
return on invested capital. You see, you only really have to do that calculation if it's not a great business or there's other issues. So he's been able to get away with it. So have
And
others. But, assuming, it's
I
very
think what you're
difficult to
talking about is
develop that.
frameworks. Like if we look at Peter Lynch's book, he talked about, okay, you could see, oh, that's a stalwart. Oh, that's a growth company. Oh, that's a turnaround. And he was able to
Yes.
classify things and then start to think, okay, how should I look at this within that framework? And I think, as you say, that's and for young people that are watching this and listening, that's a great thing. Start creating your own framework right now, today. Start creating it. Yep. I look at these three things. I want growth and I want reasonable return and I want a PE that's not too expensive or whatever that is. Write it down right now. And that becomes the beginning of your framework. And frameworks are great, because it also it saves you time because you can analyze more when you can put it in a framework and then think, okay, how does this work in that framework? Whereas many people are ad hoc thinkers. Every single thing is a new research that they got to go into. And it can work for some people, but for others that really need to speed through a lot of ideas, that's it.
So one thing you mentioned here is, at one point during my career, I decided, you know what, I'm going to read everything regardless of what I know, just start over. And so I just started ordering tons of books from Amazon. I was just reading, 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 reading. And that was
Mm,
a mistake. You know, that was a mistake because, after you've done so much reading, what you need to be reading is 10Ks, annual reports, business models in order to help develop the mindset of what you said so that all of that sort of comes together and you start defining things like Peter Lynch did. That was his thing, right? He did it that way. It doesn't mean that we should all, have the same classification as Peter Lynch, but having a framework is important. So once if I were to say like to people, name me three books, I would say, valuation,
yep.
the McKinsey book, right?
There it is.
So,
Yep.
the Bible. Okay, I'd say maybe also Expectations Investing
Right.
by Mabusin, because that's it's so simple, but there's so many concepts in there. And another favorite of mine is
Yep.
What Works on Wall Street. Just because all of these tied together. What works on Wall Street is actually the empirical evidence of the other stuff. And then expectations investing is more like, okay, what investing is, DCF is from the valuation book, but here we're coming and telling you need to take that market price and figure out what's embedded in there. And actually, this is also, I'm going to do a presentation next week, which I'm actually going to be talking about a smarter way to think about multiples. And too many people just throw out multiples without thinking about what's embedded in that. So, Hermes, he said, might have a high multiple, but what's the embedded assumptions about that? Maybe it's low growth, but it could have a very high return on capital to make up for that. So
speaking of books, so people always ask me, what are your favorite books for investing, for stocks and stuff like that. So this is them.
Nice. 100 Bagger. Yeah, I read that. Is that the Intelligent Investor?
The Theory of Investment Value, written in 1937. These are my books.
And Your Money in Your Brain was a great one by Jason Zweig that just helped me to understand like the emotional roller coaster. But that I actually wrote courses on each one of those books, and then I offer that as one big course on how to learn, because I've been asked so many times. Yeah. And so I have that. Yeah.
That's amazing.
Now we got some question. I think this is a good question here. This is a pertinent question. I'm a finance student. I want to specialize in one area. What option should I go after, which is not going to be eaten by AI? What are your thoughts about AI and how it's going to impact the business? Because I think a lot of young people are thinking about that, and what?
When this whole AI thing came out, I remember everyone got super excited. A year ago, I think it was, when I went to clusters, and everyone's like, AI this and AI that, and I have AI writing all my letters now, and it's saving me time. And I started looking at that, and I was like, what, this I don't find, all the research in this AI stuff is crap, because you'd ask it questions and it really wasn't that helpful. Now I have to admit, I am actually using it, and one way I've been using it is I made a list of, I did a screen, and it came up with like 200-300 companies. So some of these companies I knew nothing about, or I'd go to the website, and the website is this marketing blah, blah, blah. And it's like, you spend 5 minutes and you still don't understand what this company is doing. So, I found it efficient just to go to like ChatGPT or Perplexity and type in, what does this company do in Thailand, in China, wherever it is, and it'll give me a nice little summary. I actually got there's this, there's usually these codes where you can get like free access for 6 months or something. And I did that, and I've been using Perplexity. I found it helpful to help speed me up on that. So I don't use it to give me investment recommendations or anything, but it has helped me. Now, where will it go? I don't think we know. And why do I mean that? I mean, can you imagine in 98, 99? I mean, Andrew, it was just the beginning of the internet. Who would imagine how that we'd be doing this right now, 25 years later? It's impossible to know where it's going to go or how big it's going to get. So I would say, if you want to start out, rather than trying to find what's ever fashionable and doing that, I would say, what are you passionate about? Because if you're passionate about, a certain area, it will show within your work.
Yep. And one of the books that you mentioned was the What Works on Wall Street. And that was Jim O'Shaughnessy that wrote that one. And I remember getting that book and really being knocked out. I loved the way he broke it down. And I got a chance to interview him on the podcast, My Worst Investment Ever. He's episode 289, and I've just included in the link. And so for those that are out there, who are interested in that's a good one. In addition, for some people that do want to, I just shared that list of books. That course I have, I call it Invest Like a Pro, and I'm going to share a link to that too. So check it out. And Perplexity, here's a comment here. Hold on. Yeah. So what is is it Perplexity better or worse than ChatGPT for you in your work?
I tested a bunch of these out. I tested Gemini, and what was that other one? Claude or something, and Grog from X or something. From everything I tested, I found ChatGPT and Perplexity to be the best ones. I think in some of the questions I was asking, I think Perplexity has an edge into being more accurate. So I'm not being paid by Perplexity, by the way, just so that you know. But I was looking for old stuff. Like I was thinking about doing some work on some of the old Buffett investments, right? Because I was just curious, things like, Moody's, what was the embedded assumptions when Moody's listed, when things like that, right? Competitive advantage period, thinking about things like that, because that's another issue with DCFs. Just like, the better the company is, the bigger it is, the bigger its advantage. Kind of everything sort of shifts, so that valuation just goes up. You have to think about it dynamically. And when I was asking questions about that to ChatGPT and Perplexity was correct. ChatGPT gave wrong answers, and so that's where I gave it a little bit of an edge. Having said that, I use both, and sometimes I've even fed like a document into both and asked it to give me a summary, just to see just to see what it would say. And there was a case where Perplexity was more closer to the document, but ChatGPT was better conveying the message.
Yeah. And let me ask you this. One of the guests on my podcast is a guy named Larry Swedroe, who wrote this book, Enrich Your Future. It's not about picking stocks. It's about kind of asset allocation and how to invest. And but he pointed out something to me that I found very strange, which he said, Warren Buffett didn't beat the market for the last 20 years. So I went on to a website, Portfolio Visualizer, and I put a portfolio of, S&P 500, Spider, and Berkshire. And what I saw was that, he had market performance over the last 20 years. And part of what Larry says is that, the market's gotten much more efficient and the competition is just much more tough. So when someone's asking about AI coming into it, I mean, it's already very competitive. Like, is AI just going to take away all the opportunity, or what do you think?
No, I don't think so. Because you got to think also, the Millenniums, the Goldman Sachs, whatever of the world. You think these guys don't use, quant models? You think these guys don't have are using AI to the extreme? You think you're just going to be sitting behind a desk with a subscription to ChatGPT and add value? No, hell no. And you can see it through the stock price. I mean, I challenge people to find a large cap US company which isn't, either probably fairly valued or, a little bit above that. And what do I mean by that? I mean, I was looking at some of these because I own some of these, Microsoft, Meta. You take what's in the consensus. Let's just take, consensus estimate, throw it into a DCF, make a couple of reasonable assumptions, put in a whack, boom, you get to the current price, right? And one of the reasons is, you could take, there's like so much information, so many people covering it. I think, the market is very, very efficient. So something has to dislocate that. You have to have some huge worry. It was like, like a few years ago, it was $100. I added to my Meta position 115, I have an average cost, I think, of 200. I actually started selling some Meta because it's like 600, whatever now. Same with Microsoft. It's doubled since I bought it. And you know what? I'm looking at Microsoft and I'm thinking, wait, what is the embedded assumption? The embedded assumption, it has to have about 10% growth going forward. So, being the size they are, how likely is that? How unlikely is that? And are there better opportunities elsewhere? And then we talked about Jim O'Shaughnessy. You could just put together one of those, a quad portfolio using some of those stats in there, and if you back test it, yeah, it does work. But here's something that is not in the O'Shaughnessy book, and something that I found by myself, because I started using some of that and trying to mix qualitative with quantitative. And then, I was doing well some years, and a couple of years, not so well. And then I discovered, you know what? A lot of the return or alpha from some of these quant strategies comes from those years, let's say, where there's a big dislocation between what the multiple tells you and what intrinsic value will tell you. Because if you come out of like a financial crisis, what happens? All the companies are destroyed. So when you're filtering or using a quant model, you'll get a lot of good companies in those baskets as well as those speculative, which will have the leverage to push up your return. But then when the market starts to mature, you're not going to get any good companies in those baskets. All you'll be left with is all the crap companies, right? And so your return is not as good. So there still is value in thinking about it and thinking in the analysis. Now, maybe we said large cap US, but you know what? There's a lot of mid cap stocks. There's a lot of small cap stocks where there's some fantastic management, fantastic returns, and still opportunities. I mean, just look at what the idea I pitched in September for Cyprus was Ryanair, right? Fantastic capital allocation. They own all the planes. The CEO is just a legend, right? Global low cost carrier, and it was trading at 15 euros. And then you dig in, you see he has his incentive package to get it over what was it, 21? And so to me, it's a no-brainer. What was the worst case scenario? The worst case scenario is I don't make money. Whereas other worst case scenarios is like I lose money. Here, I was like, there's no way I can lose money in this investment. This company can't go bankrupt. Worst case scenario, there's less travel. Maybe they don't get to their projected 300 million passengers. And so, the upside maybe isn't as bad. So that's another thing I learned over the years I forgot to mention is, I think more about, can I lose money rather than can I make money? So I had one or two people like, oh, why haven't you looked at Wizz Air? Well, I'm like, you know what though? I think Ryanair is just safer. Wizz Air has some leverage there. Maybe you make more money in Wizz. That's fine. I can sleep at night with Ryanair with this selection. And so a lot of times it's not about if you're a fund manager. Sometimes it's not about if you're beating the S&P, because I'm not sure if the S&P is your competition. It's like more is like what how can you sleep at night? What do you feel comfortable with? And if you have a bunch of consumer staples, let's say, in your portfolio, you shouldn't be comparing it to the S&P.
I also interviewed Chris Mayer and his book 100 Baggers. So for those, I know someone said that's a great book, which I agree. It is a great book, and Chris is a great guy. I first met him many years ago when I was a broker, and then asked him to come on the show. So I've shared the link to that in the show notes. But so one of the questions I have for you is that the conference, you call it value. You have the word value in there, and when we look at the stock market, I mean, there's some amazing companies that are just so expensive, and that doesn't mean that I guess in the old days, a really expensive stock meant that you weren't going to make much money on it. But nowadays, it's like, I mean, you could be called an absolute fool for not buying a very expensive stock like Tesla or like Amazon or whatever that is. How do you think about valuation? Yeah, as you said, it's very simple. what's the return on invested capital relative to the weighted average cost of capital? If there's a premium, this company is creating value. Now the next question is, what value is the market putting on that creation of value? How do you think about these big valuations? I mean, obviously bad businesses at big valuations are a problem, but I'm just curious what your thoughts are there.
So one rule I have in my chat for Cyprus is no discussions on value versus growth. Because what ends up happening is like some guy puts something, I don't know, some high growth company, whatever you name it, Tesla, Nvidia, or whatever. And, people there's so much FOMO. I've been to like the most value called places where people eventually give up, and they'll start talking about Nvidia, or like a year ago it would be like about crypto, because they can't say this isn't for me. They just too it's like they're looking at it and it's eating them because it's going up. And one thing you have to learn as an investor is just not to care. I don't care. I don't even know how much Nvidia went up. I don't care how much Nvidia went up. I can't understand it. I can't have any insights as an analyst on it. The expectations seem high to me, so I move on. I don't fixate on it because it's going up or because my neighbor bought it. That's always going to happen. There's always going to be some guy who's going to make a lot of money because he got lucky. And some guys that go to the casino and they walk away with thousands, right? Doesn't mean that you should be doing it. And so my whole thing is I did start off as this value guy, low multiple approach investor. And then just over the years, I sort of realized, that's not value, because it's like I said, when I was doing some of these quasi-quant models, I was realizing there's a lot of bad companies, and they should be priced at a low multiple. They're destroying value. They have no growth. So it's basically a freaking perpetuity on their cash flow at best, right? And so I sort of said to them, I'm in the group of intrinsic value. I'm in the Charlie Munger group. It's not about being low multiple. So this is why I hate these discussions of value versus growth, because it always ends up being some low multiple guy is going to be raving about, how, and he'll make some stupid comparison. I've seen these in chats where some guy shows some multiple in some industry, and then someone shows some completely unrelated, but it's got a low multiple, completely unrelated. And you're like, where did that come from? So I don't believe this, and neither should you. I think this is a bad discussion, which probably started from academics, just taking price to book, right? And comparing it to, just doing these. And it's not so simple. I wish this job was simple. You know what I've told my wife many times is should have became a doctor.
That's not simple either. I'm telling you, the human body is, crazy reactive, and so many, when you think you're pulling on this, it's pulling on something else. And, in fact, you realize that everything is a system, and that's what's interesting about the stock market, is that it's the interdependencies. But I teach a course on systems thinking in business for family business owners. And part of what I'm trying to teach is that we're operating within systems all the time. In the stock market is a system that's a self-adjusting system. But a way to think of systems thinking is that the human body has got these great organs in it, and they work as a system. If we were to take the heart out of the human body and say, this is, stand alone, this is an amazing, muscle, basically, the whole system would collapse, right? So there's an interdependency, and stock market is such a fascinating one. But Zishan here has got a question. What's one single formula that you'd use to assess the health of a company? Is it ROIC? Is it, the gap between ROIC and WACC? Or
I would, that also goes back to who you are as an investor. So you have to discover who you are. You cannot be Warren Buffett. You can't be Andrew. You can't be Sophocles. You have to discover who you are. And so for me, it's about, I want to see evidence. Okay. So other people are about what's going to happen. Me, I'm like, I want some proof. So I want some proof, and that comes from, one is, like you said, return on invested capital. What is the return on invested capital? Is it above the WACC? And you don't have to be precise. Well, yeah, you should calculate the return on invested capital properly, which is not done and is not available for free anywhere that I've seen, and it's not available on Bloomberg. It's not available on Capital IQ. So one, you have to do that calculation. But it does give you, and the shortcut to that is ROE. So ROE, 20+%, then you're fine. Okay. So 2 is cash flow. Are they generating free cash flow? And 3, I don't want it to be, over levered. So I'm looking, what is the debt to EBITDA? So debt to EBITDA, cash flow, and ROIC is where I would start. And if I'm happy with that, then I go on.
So here's one of the guys in the WhatsApp group. Pawn says, how do you decide on position size?
Oh man, Pawn, I think we should bring you on here. Also answer that for what you're thinking about that. I'll tell you what. Personally, for me, my max starting position size for my personal portfolio is like 6%. I'll usually start, let's say, with something like 3, and that's just what I'm comfortable with. I have a position. I have 2 positions right now, which are a little over 10%. And I'm okay with that because I'm in the money, shall we say? But I don't know if I have. That's
and does that mean that if, let's say you start at 3%, and let's say the stock does fantastic and you like it, you don't have any reason why you want to sell it, but it goes above 6%. Would you trim a portion of it, or would you just let it go? Okay.
Yeah, I would just let it go. But then the funds I had managed had a mandate, and it was there was strict limits. So on that, I have to say, I just followed the mandate because I couldn't work out of that. When I worked with the activist fund, there was no limit. So we did have like a position which was like 25%.
And this is it's where you have some competitive advantage when you're not a public mutual fund, where there's a lot of restrictions on concentration like that. But as you say, so tell us about 25%. That's crazy.
Yeah, it was something like that. I can't remember the exact one. It got way too big because it did way too well. And the mistake that happened there was, to me as Sophocles, I was like, guys, this is the industry it was in. Doesn't really justify that position. So if you think, industries which are more cyclical, right? So I was like, man, I would trim that just because it's one of those industries where you don't know what the heck's going to happen next quarter. This is very sensitive stuff. Take some profit off the table. And then that was my view. But it was a little bit of an issue because of the liquidity. And the one lawyer was worried that might create some issues. So he was overly worried, I think, about if we sell, maybe we have problems. And it was just being too conservative. You know what I mean? I was like, why? It's like, okay, we have a big position. The guy could be, one of the guys is on the board or something. But you know what? It's like, you're an investor. You can't just hold on and this profits forever, especially, you're not holding on to, I don't know, Microsoft, which you bought at, 50 or something, let's say. And, I hope that makes sense. I'm sorry, Pawn, I haven't given you, I'm still learning on that myself, but it's definitely not, what is that? Kelly's criteria is definitely not that as well, because I think one bad lesson I personally out of Monish Pabrai's book, The Danto Investor, was he was talking about, really go, I got this impression you should have like this take on a big position. And at that time, this was years ago, I was so convinced Tesla was going to fail. And I had like all the models set up, Bernice model and everything you can think about, right? And so I had all these put spreads on on Tesla, and obviously everything, they all went to zero.
Yeah.
So that was a big mistake on my part. Big mistake. And I got a lesson out of that, obviously, of like, regardless of the financials, if there's enough cult following,
never
you know,
underestimate
you
how
can still
far
lose
something
money.
can go up, you know, way beyond what you think. We got another question from Hashir. He says, in general, how does the optimal portfolio look like to you when invested in different asset classes? Now, you're generally investing in one asset class, which is equity, but maybe, you know, from your debt experience.
Yeah, I would say you should. I don't believe this whole, 60/40 has done really well, but so has, Harry Brown's, what was it?
Dent?
The Harry Brown's portfolio,
Permanent.
what permanent portfolio? Is that what it's called there? Yeah, there's a book out on it. Actually, if you do some back tests, it does pretty decently as well. Um, I'm more, I'll go where the opportunity is. So for example, I bought some defaulted Lebanese debt. Okay. And that's why, because you remember, Andrew, I used to work for an emerging markets hedge fund that did do distressed debt. And, it went down to as low as 6 cents. Now it's back up to like, what, 17 or something. So that to me was an opportunity. Argentina, when they came out of the default, I actually bought myself personally with a friend of mine. We bought some province of Buenos Aires. I've also done, things like, there were opportunities people could do, like the spread. There's one point where the amazing spread was Turkey versus Russia, right? Two emerging countries where I think the fundamentals in Turkey at the time were significantly worse than Russia, and so that was a good trade to play the yields off of each other for narrowing the spread. So I would say, the only time I did like a balanced portfolio was part of my mandate. Personally, I'll just, if there's an opportunity in bonds, then, I will take it. But the problem is what tools do you have? So do you have a Bloomberg? If you don't have a Bloomberg, I don't know how you're going to be doing multiple asset classes. So it starts there. So if you don't have a Bloomberg, then forget it. And just stick with whatever you
and I can answer
on
this question a little bit because of the asset allocation portfolios we have in Thailand. But basically what we look at is stocks, bonds, commodities, and gold. So you can say that gold is a commodity, and so you could say stocks, bonds, commodity, but we break out gold separately. And we are, because we're diversified across all those different asset classes, we can take a little bit higher position. So we've been up to 25% in gold for a while. And, I wouldn't generally advocate that on a long-term position, because gold really has its spurts. It's a little bit like commodities. Commodities is good once every 17 years when there's this huge spurt in inflation. And so, if you can have the option to have it, but I would go back, and my answer to this, Hashir, is that ultimately, to be successful over the long term, your core holding must be equity. And I look at the debt aspect of our portfolio as a tool to reduce the downside of equity. I look at the commodities is a tool to add a little bit of spice when inflation starts going crazy. I look at gold as a tool where you could say it's almost zero correlation with equity. If the equity market falls, gold generally is going to protect us. I think where you can get in a little bit of trouble with that multi-asset class thing is when you're thinking you're going to get a gain on all of these things. And I think it's better, from my perspective, what we've been doing is just focusing on, having a function for each one of those. But equity's core.
Yeah. And that's that was the thing. That's the thing that I think Harry Brown was trying to do.
And by the way, Pon says,
I'm sure.
Thank you both. You're welcome. And also, just for those people listening, the Harry Brown book is called The Permanent portfolio written. The first edition is a Kindle. There is a Kindle book on it, written in 2012. It's got a 4.7 out of 5 rating with 220 ratings on Amazon, which is very good. And I put a link in the show notes to it, so you can click on that link and check it out. I haven't read that book, actually.
Oh, it's I think he just rebalances it every year, and I think it's like what is it? 25% equities, 25% bonds, 25% gold, and maybe 25% cash or something like that. So, but along what you said, I'm sure there's people in here, and they're also thinking crypto.
Yeah. A lot of crypto. A lot of people ask me about that.
Have you looked at it at all?
One part
Andrew,
of my business is outsourced CFO, and I was the CFO of a cryptocurrency exchange here in Thailand for a couple of years. We sold that to K Bank, and so they've now got it, and they're doing great things with it. But for me, my investment strategy is kind of weird. I'm a little bit of a barbell type of investor, where almost all my focus is on my own business. And CoffeeWorks is a big, investment for me. And therefore, on the other side of that barbell, I got to be low risk, because if we are in a situation, we don't want to ever be diluted from our equity shareholding in the company. And if we are faced with any problem, that means that, yes, we can get some support from banks, but we have to make sure that we're protected. And so that is my number one investment.
Well, I'll tell you, I went down the rabbit hole at one point because I had this one guy who came to my event and he presented about this project on the Ethereum blockchain. And I was like, this is so cool. So I started, and I no longer look at any of this stuff. The only thing I do check is what's the volumes going on the Ethereum blockchain. And I'll get to that, because I started studying the projects and going through the white papers. And I think people ask all the wrong questions. The majority of people are just looking to make a quick buck. And that usually ends up in catastrophe for those who are thinking like that. No matter if it's crypto, no matter if it's like a penny stock, right? Or no matter if it's the next potential NVIDIA or next potential Amazon. So the problem with crypto is, and whoever's in here thinking about that, is just whatever project you're looking at, look at the incentives and try to understand, one, the incentives, and two, the economics. And I have to say that 99% of the time, one of the two did not make sense. The incentives, as in you check it out and you work out the shareholding, let's say, right? Or the token holding or whatever, right? Who gets rich? Yeah. And then the other one is, how does the economics work? What's the project? Does it solve like something in the real world? Or is there already a solution that's, so you have to offer something which is 100 times better. And I ended up stopped doing that. I made a little bit of money, not much, but I made a little bit. And I actually converted that all into Ethereum just because I was thinking long-term, this is like an option. There's potential here. There's a zillion developers working on this. And I can see that. I can see what I liked about it was that you had these exchanges where no one could stop them. So let's say you owned shares in, Sberbank, right? After the war started, or Gazprom, right? After the war started, everyone got screwed. And who got screwed? The foreign investors. This is the funny thing, right? So Europe and the US, they put all these restrictions on the shares, and it's not the Russian companies get hurt. It's the foreign shareholders. And then we even ETF. So imagine someone bought an ETF, right, to diversify, to lower their risk. They bought an ETF, right? And the ETF gets liquidated, and they lose everything, right? If this was on the blockchain, they wouldn't be able to do anything, right? So anyway, that's just a totally, an optional thing. But I'm saying, people be careful of the crypto scams, because I think 99% of them are going to go to zero.
And speaking of Russia, I had a guest on, William Browder, who wrote 2 great books called Red Notice and Freezing Order. And basically, he had a lot of involvement with Russia. And the title of that episode, he was episode 783, and the title was "Don't Go to Russia." And he had invested in Russia and lost everything in 1998. Yeah,
That's a great book.
he's amazing.
That's a great
So
book.
I put that in the show notes. Here, Roman's got another question. He says, did you actively use CDS contracts when investing in emerging market debt?
Personally, I didn't, but yeah, the other guys in the team did use CDSs. So I'm sorry, I can't really. It's not really something I focused on. So
we're gonna wrap up, and I just it's been great talking, and should have been doing this a long time ago. And but and I like all the stuff that you're doing, and particularly for those people that are interested in going to Cyprus for the event, check it out. I've given the link in the show notes for the Asia Value Investor Conference, and reach out to Sophocles on LinkedIn. He's right here. Send him a message, make a comment, tag him. He'll respond. Or if you can't get him, or if for some reason you're connected to me and you want to send me a message about it, just send me a message, and then I'll put you guys in contact. So
yeah, I mean, Cyprus is pretty packed because we're already fully booked. So I've actually started a waiting list, but Asia is going to be the new thing, and it's probably closer to most people in the chat. So hopefully, we can get like a nice little community going. I know Andrew and I and Pon, who was in the chat earlier asking questions, is going to be there. We've got about 15, 20 people right now. So hoping we'll have around 15, 20 ideas to share and everything. But even if you can't, just find your investor friends and schedule something. It doesn't have to be every week. It doesn't have to be every month. It can be every quarter. Say like, you know what? We're going to put this down in our calendar, and we're going to meet every so time to discuss an idea, work together on an idea. It's not a competition. That's what people don't understand. And people's like, oh yeah, I got to hide my ideas, hide my alpha. Who do you think you are?
Yeah, it's not like you got billions of dollars that you got to move into that position. So, yeah. So share the ideas, find some good people, as you've said. I think that's really good, actionable advice to wrap this up. And that is, whether you can make it to one of these type of events or any others like it, great. But if you can't, start reaching out to people around you and start talking about stocks. It's something that will be fascinating for a lifetime. Okay. Any last word you want to share before we wrap up?
Yeah, I guess you have to decide. Ask yourself also, what type of investor am I and why am I doing this? Because I think a lot of people, they like the idea of the investing because they think it's an easy way to make money rather than be like, like to torture themselves over an Excel spreadsheet. So, or doing research. So if you don't like to torture yourself in Excel, then you're probably, this isn't for you.
Yeah. Yep. Do what works for you. In fact, what we say is you do you. That's the secret of life, really, is figuring out how to be more of yourself. And I like this discussion. So I'm gonna.
I say that to my kids. Andrew. Like I tell my kids, I got kid 10, 12. I'm like, when you grow up, you have to be passionate. Where is your passion? And that's where you add value to your life and to other people.
Yeah, and I've found mine, and I love teaching. I think that's something that has been with me all my life, and I love reading and I love learning, and so I've found that I am able to bring together those things into teaching on my valuation masterclass, and that's been a blast. So, all right, I'm gonna take you out of here and say goodbye to the audience, but just hang on, don't go anywhere, and then I'll talk to you in a minute. So. Awesome. Yep.
Thank you guys.
Well, that was great. What a great discussion. And Sophocles is an experienced investor with many years of experience, and you should definitely check out that Asia Value Investor Conference that he's got coming up in March. It's going to be some interesting people. I've seen the discussions going on in the WhatsApp group of the people that are attending. They're all very impressive individuals who are each, coming up with their own stories and their own ideas of investing. And I think I'm just going to wrap up myself by reiterating what Sophocles said, which was the idea of start talking. If you're interested in stocks, start reaching out to people and saying, hey, let's talk. Let's go through some ideas. Let's start sharing. And I know that when you do that, you're going to find out if that's really your passion. And if it is, there's a whole world out there. So I want to thank you all for attending, and so many great questions and comments. I haven't done a video in a while, so I really appreciate it. This is Andrew Stotz of the Valuation Masterclass signing off. Hope to see you at valuationmasterclass.com at some point coming up. Have a great